Okay.
All right. So, hey everyone, I had already had hit record, so I want to welcome everybody to another. And of course, we start. Peter's such a busy, important guy. He's got phone calls left and right.
I don't know how to mute it.
That's fine. I'll keep rolling.
No,
Hey, this
there
is
we
our
go.
weekly recap. Don't worry about it, man. This is our weekly recap. We're going to zen out. We're not going to let it distract us. Oh,
Sorry.
as you can see, Peter and I were just really average guys, nothing polished or professional. If you're looking for that, you're looking for the wrong community. But we are average people, showing you how average people, despite what the experts say, can actually build wealth in the stock market. It's not as hard as people make it seem. Of course, we're going to show you our real trades, our portfolios, things like that. Everything we're sharing is for educational and informational purposes only. So with that, what I'm going to do is share my screen real quick. This week, I have last week our recap ran over a little bit, so I had to edit a ton. So I'm going to drop you into a lesson I shared last week that just didn't make the cut, and you'll get to hear that this week. But first, what I want to do, Peter asked me to cover the market real quick. I I was laughing before we started, and I said, you know what, maybe because I grew up in an abusive environment, I'm addicted to drama. Like the stock market is just raging higher this year. I mean, it's just gone nothing but up. And it's annoyed me. You know, you think I'd be happy, it's all this easy money, but I'm straight annoyed. It's almost like I want the drama, and that's kind of crazy. It's twisted. It's a twisted way of being. But
Mm.
the market's just gone up. I'm still trading what I see, and I put in my Excel for members of the Success Academy. And sorry, I didn't introduce Peter. Peter's my co-trainer for our high-end coaching program in the Success Academy. So in that Excel, I let members peek over my shoulder. They see every single trade I make. As a matter of fact, our account is up. Best case scenario, increased 86% so far in 2019. It's a combination of personal contributions I make to it as well as investment returns, and I have that broken out here on this Excel. So members get to see this. It's a case study of our 5-year retirement plan, showing people how to take a 10 grand account, grow it into a 6-figure account in 5 years or less, and with that 6-figure account, hopefully produce enough income so that you're financially free. Now, with that being said, what I was going back to is I put in my Excel for members that I'm trading what I see. The market's going up, so I'm still trading bullish trades, which means I make money when the market goes up. Because what's in my head is the market's going to crash. And I said, if I had listened to that negative head trash, I would have lost money or missed out on all this gain because I feel completely nervous. Like I do not trust the market. There's nothing, I have all this uneasiness inside and all this crap in my head, that will prevent me from making trades. Like I just made a couple of trades yesterday and I didn't want to make them. I'm like, the market's going to crash. I know it is. Let me just wait until it crashes and then place the trades. But I always have to revert back to the truth. Trade what you see. No one can predict the future. We don't know if the market will crash. So when it crashes, that is when I will change up how I trade. But until then, I'm going to trade bullishly. And you see the results of that. Trading what you see. This is not an accident. It's not luck. It's what I found is that when you just listen to what the stock market is telling you, you can do just fine. Right? Investing, as I said in the beginning, investing doesn't have to be as difficult as people make it seem. So with that being said, I will drop you into last week's lesson and I will be right back. All right. Lastly, I will leave on this topic of insurance. A lot of these trades, I was telling Peter, I have about 11 grand out. He laughed at me. I was like, I have 11 grand out in a risk as far as directional trades, call options. That's a lot of money to be out in call options. But I also have insurance, right? Equal about a 9 or 10 grand worth of stock market insurance. Yes, you can insure your account. I don't care what the haters keep telling me. That's a hedge. That's not insurance. Whatever. Call it whatever the heck you want. It's designed to, like Peter said, when the market falls, I'm either break even or I'm making money. But the number one objection I have is people don't like the cost of insurance. It's a huge objection. They look at how much it costs, and the one guy said, "Doesn't it drag down your performance?" Yes, it does. But let me show you what I know from experience, and that's why I say you have to get out your head. Your head is going to hold you back. You have to get in reality. Here's my reality. I pulled out. This is a Starbucks trade. You will see it in my journal up here, but it's put in with a bunch of other trades, so you can't see what's going on. So I singled it out. I'm doing several principles here, the 3X growth strategy, as well as the stock market insurance principle. Okay, so here, I bought some call options here on Starbucks, risked about 680, but I also bought insurance, $400. So my insurance is almost as much as my calls, and that's what people look at. They're like, that's $400. Travis, you won't start making money until that $600 investment has a huge return, and you're just bracket break even because you bought insurance. It's dragging down your return. Yes, it is. But if you look at the total here, I've added it up here. All my calls plus my insurance is only $1,000. But think about it. It's $1,000, but I'm protected, right? What puts people out of business is never making money, it's losing money. What makes people quit trading? It's because they lost all of their money. So I'm protected against that worst case scenario. I'm following Warren Buffett's rules of, hey, let's focus on not losing money. He doesn't say focus on doubling your account every year. He says focus on risk, not losing money. So I've taken care of Buffett's rules. Now I can just focus on profit. Now let's move on and see what actually happened. Not what I thought was happening in my head, but what actually happened. Starbucks went up in price. Those call options increased in value, almost double. I sold them here for $1,300, right? So think about it. My original risk with my insurance is $1,000. I cash out just on the calls for $1,300. The calls already paid for my insurance. Now I'm up $300. Right? And my insurance is fully paid for. I could walk away here, but guess what? Market Club didn't give me an exit signal. Starbucks is still running up in price. I re-entered, I compounded my profit. Before I was making 10, 20, 30% return on 600. Now I'm making 10, 20, 30% on 1,300. So now my account is going to build up much faster. And so what I have down here is my book profit, the 220, and that came from 1310 minus 1090. And then my current profit, because remember I compound and I got back in, my current profit on call option is 584. So that's open trade. I haven't booked that or anything. It's still open profit. Starbucks is still going up. Earnings is coming up. Fingers crossed, I hope Starbucks jumps up. So this 500 can go to like 1,500. But regardless, you add those two together. I now have an $800 total profit on Starbucks. I started with 1,000. Including my insurance. If you just include the call option, then I've more than doubled my money. But I don't just include the calls, I include my insurance. So not only do I have a profit, I also protect it from worst case scenario. I'm sorry, like, how can you argue with that? And that's why I don't know how many ways I can say this over and over again. Like, I don't know how many other different ways I can say it. I'm just gonna keep demonstrating it.
I think so. One of the things, if sometimes I don't always catch it either. So just wanted to point something out. Your protection as well, it goes out till January of 2021. Yeah. So that protection is a long ways out. So he, any of you guys that are watching this, his protection's now in place for all his future potential trades. So that's first and foremost. The second thing is, I wanted to actually ask you a question. What's your calculation for your protection? So you bought a $70 call option. I imagine you were buying an at the money call at the time. Is that correct?
Yeah. At the money.
So do you calculate a 20%?
Gosh, man, you're giving away all my secrets, everybody, man.
Oh, I'm sorry.
I'm like, I was supposed to. This is only for Success Academy members. That's why I'm over here cracking up. I'm like, Peter, I wasn't even gonna teach on that. I was like, but you caught it. No, that is good. Well, that's fine.
You can edit it out.
No, I won't. Non-Success Academy members, somebody sent me a hateful comment over the weekend. So guess what? You get value added. Yes. Point number one, you're right. If you're quick on this, and I love this, you caught this. The reason I bought my insurance way out, because I'm like, okay, I'm going to stay in Starbucks about a year or so. I'm going to make a bunch of money on it, potentially. But the corrections might happen 3 years from now when a market crash. I want to be in a position to profit even when it falls. So I'm making 800 now. My protection is paid for. It's already paid for. I'm just going to let it sit. And then if Starbucks, maybe a scandal happens a couple of years from now, I'm in a position to now make money when it crashes. So yes, that's why I did that. Because it protects all my future earnings, all my compounding earnings and things like that. And the more I make, I can even add more insurance to it. Second point is I don't really have a rule, but I'm finding that about what I did recently for my earnings trades for my kids, they earned some trades. So we spent $680 for call options. What I found is a good offsetting is 20%. So we will risk about 20%, give or take, buying puts. So we will look to spend about 136, maybe 200 on puts. And the reason why is if you've traded calls for a while or even puts, you will notice options fluctuate in value, sometimes 10 to 30% in a day. So if I only spent 20% of my money on puts, then within a day or two, the profit from my calls have already recouped my put costs. That's the formula I found that I like the best because I recoup my puts more or quicker. I recoup the cost of my puts quicker. With this one, you take 410 and you divide it by, what was it, 680. You can see I spent about 60% of my money on insurance. But the reason why, think about, remember my 20%? The 20% was for short-term insurance. So I've done 20% maybe per year here. So because I went so far out, like you just pointed out. So it's about 3 years out, give or take. So regardless, it's about 20% a year. I'll recoup that in a week. Well, I've already recouped it.
So when you're looking at the option chain, you're looking at the cost and then just kind of bringing it over to the strike price. You're not looking for a specific strike price. Okay.
No, some people do. I do. I run mine mostly by numbers. A lot of people do deltas. I don't. I'm always trying to simplify stuff the way my simple brain thinks. Yeah, I probably could perfect this even more looking at strikes, 5%, 10% out of the money, but I don't. I'm looking at the numbers. If I can double this $680 within a couple of weeks, that's what I'm looking at. I mean, it doesn't matter what strike I put if a trade doesn't work out. So, oops. Sorry, everyone. That's my time.
So,
go ahead. All right, I am back. So I'm going to turn it over to Peter. And before I do, I have one quick little confession to make. I'm going to share it and talk about it on our Success Academy live call tomorrow. But Peter and I already discussed it behind the scenes. I have entered the U.S. Investing Championship. I'm currently in third place. That's about all as I'm going to talk about on this recap. We will talk about it on the live call. But moving on, last little rant here. I'm not political. I'm politically agnostic. Just like I'm strategy agnostic. I don't have a particular strategy I like. I don't know if I told anybody this, but I was thinking it mentally. I heard about this movie that came out this weekend, and it made 1.2 billion in one weekend. And all I kept thinking was like, wow. And there's nothing wrong with movies. I go to the movies. I love movies. We spend a lot of money at movies, more than we should. But $1.2 million. And the point, billion. Collectively, as a whole, you all have more power than you know you have. So all these people whining about taxing the rich and universal income, not saying they're not great programs that can help people, but they whine about it from a victim standpoint. I'm like, hello, you all going to the movies collectively in one weekend now, not a year, but in one weekend, you raised $1.2 billion. Can't you give that money to a billionaire like Buffett, have him manage it, and then the profits is what you can use to fund all these programs instead of perpetually taxing me for the rest of my life and watching you squander the money? So it's like there's always a smarter approach. All these people saying, oh, we need money. It's not. I was like, just look at what a group of people, when they got together and they committed to something, we're going to the movies, how much money was raised. Just imagine if you can do that on a bigger scale and then have that money invested intelligently, which you can accomplish. So that's my rant for the day. With that, I'm going to turn it over to Peter.
Darn, and that kind of goes to what I was talking about earlier with what
I was like, should I even say this? Because Peter gets so worked up.
I do get worked up, but I'm not going to go. I won't go on a rant. I'll keep it.
It's going to burn into you. You're going to say it later.
Yeah, it's okay. All right, so let me show you guys what I've done here. So this is my new spreadsheet that I'm working on. So I've never showed you guys, I could never really show you all the trades I do because they're in real accounts. I didn't really want to show you my real accounts. But I did want to point something out. And I'm not completely finished. So let me just be very transparent. You see these numbers like the July trades, the May trades. Those look like really good numbers, but understand the reason that's in July, if you look, let's take July. These are covered calls that I sold back on February. They expire in July. So I put them in the July statement because that's technically, once I close out the trade, the last part of that trade will go into this July statement. That will really show my income. So this may show a $1,400 gain for July, but it's not realized. That's basically what you would take from that. Whereas take April, this $369 gain is realized. That's what I made for April, $369. And for March, I did even better at a negative 158. The one thing I did want to point out, me and Travis were talking about this. I don't remember if we covered it on the live on our recap last week, but I did not really take advantage of the market. If you can see, look, I didn't even trade in February, no trades. These January trades, that seems like a lot. It's a lot of losses. Now, not all of them are losses. Like January actually isn't that bad, because I'll point something out here. If you look at this SPY trade here, I'll highlight it. If it highlights, this SPY trade is a call option that expires in January 2020. So I haven't moved that into 2020 or taken it out. So if I were to take this out of here, you can see that January wouldn't be as bad as it really was. It was actually up, because that call option is an expenditure. But that's how we do it. We say, hey, we spent $1,400 on call options here, so then that's what we do. I think there's something missing, because that call option was technically paid for by some cash secured puts that I sold on SPY. So something's wrong. But the point is, this is kind of what you guys will see as we move forward. I'll just focus on the upcoming month. So April, I'm pretty sure this is it for April. So this is all the trades I had. The rest of my trades are out into the May, June, July timeframe. So April, yeah, I only made $369. But I want to point out something very important. One of the things that I've been lacking is being consistent with my trading. Travis, this is something Travis has worked really hard with me on, because I need consistency in showing up every day and doing my trading. And we were kind of talking about it, how I focus a lot of my attention on my contractor work, and I don't focus the same kind of attention on my trading. So I want you to see the difference when you focus a lot on your trading and when you don't. So when you don't, you see losses, and when you do, you see gains. Now, these aren't all realized gains. I will say in many of the May trades, they are, because these, like the SPY and Facebook, let me look at May real quick. Actually, this is correct. So May is all pretty much realized. These are all closed out. No, my vertical here, this vertical here is not closed out yet, but just about everything else is closed out. So that's my May, pretty much my May realized gain. So the worst case, that would be $1,000. So you can see the difference. When you show up every day, $1,000 a month. When you don't show up, you're sporadic, $158 loss, $369 gain, so that's the big thing I kind of wanted to touch on. SPY is going higher. Yay. I have credit spreads on SPY, so it's doing good. Apple, I want to cover my Apple trade. I've talked about this a lot, how you have to be very patient with Apple. So I own 2 call options with Apple at $200. So they're still profitable, even though Apple's going down. Today's earnings day, so that really accounts for why Apple's doing it. We talked about it last week. I remember I said, I'm going to close these trades out on Friday. Well, I didn't. And I'll tell you why I didn't. Number one, my trades have 81 days. So based on the template we use, we get out 30 days prior. So my trades have 51 days. That's a long time. Number two, I decided to buy protection to help with reducing my loss. So what I mean by that is I spent $1,600 on my call options because I bought 2 of them. So if Apple really tanks over the next 2 months, I'll have to sell those. I have an exit strategy at 50%, so I would take an $800 loss. Well, if Apple tanks this week because of earnings, I have a put option right now that's generating, right now it's at it was at like a 65% gain. I just bought it the other day. It's just protection. It expires on Friday. I'll sell it tomorrow, most likely. We'll see what happens with Apple over tonight and into tomorrow, because earnings will be announced after the closing bell. So We'll see what happens. I'll give you my prediction. I don't like to do this all the time, but I predict Apple will eventually go higher again, even though it has pulled back. And the reason I'm just saying that is because I do some back testing. It doesn't always follow back testing, but sometimes the odds are, well, most times the odds will be in your favor if you're back testing a stock. So if you look at earnings when Apple was going up, it had a nice little pullback just like it's having today, and then it shot up. That was back in July. And then this one, same thing, right? Apple was kind of going up and then it pulled back right before earnings and then it shot up. Over here, it didn't do it as much, but if you look, maybe a week or two later, it shot back up. So I'm kind of anticipating Apple will do the same thing. If it doesn't, then it doesn't. It's not the end of the world. Facebook was an opportunistic lucky trade for me. So I call it opportunistic luck. I always give Travis a hard time because he says I'm lucky. And I say, you're not lucky, you're opportunistic. I used to always say you're fortunate, but I heard something from Ty Lopez. So I'll shout out to Ty said this. It's opportunistic luck. I wouldn't have been lucky on my Facebook trade if I wasn't trading credit spreads or if I wasn't doing what I'm doing today. So you can't get lucky on a trade. It's just like the lottery says, right? You can't win if you don't play. Don't go play the lottery. I'm not telling you to do that. But the reality is I got lucky because I sold a credit spread based on a market club template. And you see, Facebook was going up. So my market club template was satisfied. I sold a credit spread 20 days later. I got my 80%. I do a good till canceled. You guys know this. And it cashed out because Facebook jumped way up here. For what reason, I don't know. And this is why earnings, a real quick thing, look at it, it did horrible on earnings and it jumped up. Whereas conversely, AT&T did great on earnings and it dropped down. So that's why you can never really tell what's going to happen on earnings. So that's my Facebook trade. And so between my Facebook and my SPY trade, those have sold out for 80% of my gain on credit. So those are good trades. Facebook ironically made a lot of money in a short amount of time. So I was opportunistically lucky on that one. The last thing I'll cover is AT&T. I always cover AT&T, and I want to make something very clear. I do not trade directionally or credit spreads or any of the strategies we teach in the Success Academy. I don't trade that way on AT&T. Why? Because look at it. It's not a stock that you would want to trade a vertical credit spread on for like a bull put spread. I don't even trade a call bear spread on it, even though it's going down. And the reason why is because AT&T, if you take a 5-year chart, AT&T just kind of sits at this range for over a long period of time. The main reason, look, a year ago, it was a little bit higher. It was at 35. Today it's at 31. It just doesn't really go anywhere. It had that big stint here back in, I think this was 2017. And then it just came back to where it usually trades at. AT&T is not a stock that I trade options on in this sense. It's more of a stock that I own for the dividend. So that's what AT&T is for. So if you're trading credit spreads and you're wondering why they're not working, or you're trading any kind of directional option trade on AT&T and it's not working out, that's why it's not working out. It's a horrible stock to trade options on because of, one, it doesn't pay really good premiums on their options, and number two, look at the stock. It doesn't really go anywhere. But that's not why I'm in AT&T. I'm in AT&T because I collect a really nice dividend every quarter. So my last stock that I'm in is Nike. Nike's just kind of flounder, and I needed to get to that $90 level, which is a high for it. I'm probably going to write this one off as a loss. It still has plenty of time, but it's probably going to turn out to be a loss because it's just kind of sitting there. Now, every day it sits there, ironically, my credit spread doesn't lose money, which is cool. It actually just kind of sits there. So I'll probably most likely take either a small little gain or a loss on this one. And that's okay because my SPY and Facebook trades more than made up for it. So I'm looking at, for the future, I'm looking at Coca-Cola. Horrible looking chart if you look at it here, but it triggered a market club, and if it gets above this high, I think it's just going to keep going higher. It's not the best of looking charts, but it's something I'm watching. Again, when I mention something I'm watching, it's just something I'm watching. And then I'll get back to, I have these on my watch list, my McDonald's. I don't know why I haven't been trading credit spreads on this one because it's just doing great, you know. So those are some of my watch list items that I'll look to do over the next coming weeks. And that's it, Travis.
All right, buddy. I have a quick question. I know it's going to take this recap a little bit longer, but I feel I have to ask. Real quick, let me do one more thing. I'll ask while I'm doing stuff. So sorry, everybody. I'm not going to be looking at the camera. I'm multitasking. But why are you trading AT&T for the dividend when there are other ways to get a 6% return from your account in a lower risk way? Like, I guess I won't, like price point profits. I taught that bonus in the Success Academy, or various other strategies we could use. You could set your account up to still return a 6% of dividend or equivalent. It's like what's what I'm looking for. It's what do you do when it's not a surrogate, like a surrogate dividend, like it represents a dividend but in a lower risk way. So why aren't you doing that versus tying up all of your money in AT&T for a measly 6% dividend?
Because my wife and kids don't know how to do it right now. So that
There
dividend pays that dividend pays out, and they don't have to do anything. The only thing they really will have to pay attention to is what AT&T does. If AT&T, right now, it's one of the largest telecommunication stocks out there, companies, I should say, not stocks, but companies. So we can never rule out a company going bankrupt, but
yeah.
I do follow that portion of it, and I download the statements, but that was the main reason. I was going to invest more, but right now it's just going to be actually utilizing that strategy you showed me to eventually invest more, because my kids and my wife don't have to learn anything. And the reason I say that is if I ever died, they can't do this. So they would lose out on that 6% dividend if I was doing it this way. Whereas the way I'm doing it, they'll continue to get that 6% dividend. So that's why I did AT&T.
Yep. And I sign up on something like that. That's what people don't understand. And it's a lot of, I was telling Peter, it's the curse of being a coach. People see you do stuff and then they want to model it, but they don't understand like why you're doing it, because why you're doing it matters. Because for 6%, Peter could come up with 100 different ways to earn 6% that are way less risky than the route he's going. But they don't accomplish his big why. I want to set my family up for the future. Like same situation I run into. Like my wife and kids aren't, savvy option traders like me. I'm trying to set up a portfolio that they can take over, and they don't need to be me in order to make money. Peter's doing that. He's thinking also in the present day, but also the future. When I'm gone, can this legacy continue? And yes, the way he set it up is, they'll still collect the dividend as long as AT&T is still in business. But if it's not in business, they'll hear about it beforehand and they can always sell it. But he's structuring things so that he can make money now as well as his family in the future. And that is always a beautiful thing. So unless you have anything else to add, I think that's a great point for us to stop on.
That sounds good to me.
All right. Well, everyone, hopefully this week's recap was a little bit smoother for you. Last week, Peter and I were all over the place in our conversation. So it wasn't our best recap. But this time we're going to officially end it, and we will see you all next week. As always, we hope it added value to your life. That's our goal here. We don't just do this for us. Well, we like talking to each other, but we always do these to add value to your life. So if it's missing the mark, or if there are things you want us to do, questions you want us to answer, you have to speak up and let us know. But until then, we will see you in next week's recap. See ya. Talk to you soon. Bye-bye.
See ya.
All right.